For nearly 4 years, something extraordinary happened across America's rental market. Rent prices didn't just climb, they exploded at a velocity that caught an entire generation off guard. From Miami to Seattle, property owners operated like they controlled the economy itself. Overnight, rents jumped by hundreds of dollars, and landlords expected desperate tenants to somehow make it work. But 2026 has completely reversed that dynamic. The iron grip landlords held over the market is slipping away fast. Cities once defined by bidding wars are now flooded with vacant units. For the first time in over a decade, rents aren't just declining, they're plummeting. If you're finding this valuable, hit that subscribe button and drop a like. It helps us bring you more content like this. Developers overestimated demand, investors stretched their finances dangerously thin, and renters hit their breaking point. In major metros, prices are crashing by double digits. Move-in specials, waived deposits, free months, they're flooding back. Landlords who once called the shots are scrambling. The power structure is shifting. Today, we're breaking down the 10 cities where this collapse is hitting hardest and where the future of renting is being rewritten in real time. Number 10, Austin, Texas, when the tech dream shatters. Austin's meteoric rise reads like a Silicon Valley fantasy, but its descent is equally dramatic. Between 2021 and 2024, this Texas capital became the embodiment of America's tech migration. Remote workers flooded in, venture capital followed. Billion-dollar startups abandoned coastal offices. Austin proclaimed itself the next Silicon Valley, and briefly, it seemed possible. Construction cranes dominated the skyline. Gleaming towers materialized overnight. Landlords pushed rents upward at speeds that left longtime residents reeling. But 2026 delivered a harsh awakening. Average rent has crashed approximately 15%, one of the sharpest drops in the Sun Belt. Those pristine towers now stand partially vacant, rooftop pools echoing with silence. Developers who boasted about waiting lists now dangle desperate incentives. 3 months free rent, 0 deposits, even concert tickets. The tech sector that fueled everything cracked open. Massive layoffs from companies like Meta, Oracle, and Tesla eliminated the high-income renters who sustained the ecosystem. In upscale developments like the Independent, vacancy rates have hit decade highs. Even East Austin, the creative heartbeat of the city, has landlords slashing prices just to compete. Investors who borrowed aggressively during the boom are watching profit margins evaporate beneath crushing interest payments and vanishing tenant pools. For renters, though, this represents a long overdue correction. The city that became unaffordable overnight is finally cracking, shifting leverage back to those who actually live and work here. Austin's message in 2026 is unmistakable. The city that climbed fastest is falling just as hard. Number 9. Miami, Florida, when paradise prices itself out. Miami's rental explosion was absolutely blinding. Fueled by pandemic relocations, cryptocurrency millionaires, and international buyers chasing prestige beneath the Florida sun, the city transformed into a playground for the ultra-wealthy. From 2021 through 2023, rents rocketed upward by over 60%. Locals were priced out, and sleek towers became monuments to excess. But 2026 has stripped away the glamorous veneer. Average rents have dropped roughly 12% in a single year, and vacancies are climbing across Brickell, downtown Miami, and Miami Beach. Those luxury buildings with ocean views are throwing out every incentive imaginable: free parking, waived fees, even $1,000 gift cards. The problem extends beyond soft demand. It's mounting costs, crushing owners. Insurance premiums have tripled. HOA fees are jumping as buildings comply with Florida's post-Surfside safety regulations. Countless investors are bleeding money monthly. Units that sold for $900,000 now struggle to reach $700,000 or sit without offers. Airbnb operators are shutting down as tourism cools and costs devour profits. Even foreign buyers are pulling back, spooked by hurricane threats and special assessments. From a distance, Miami still looks like paradise. But underneath, the numbers don't add up. Miami in 2026 serves as a warning. When luxury outpaces reality, even paradise cracks. Number 8. Atlanta, Georgia. The exception that wasn't Atlanta was marketed as the exception, the southern city that balanced it all. With thriving jobs and affordable homes, it looked like the smartest regional bet. Developers responded confidently, pumping billions into sprawling complexes from Midtown to Sandy Springs. Between 2022 and 2020, over 50,000 new units came online, far exceeding what the city could absorb. Now in 2026, that optimism has evaporated. Rents have slipped about 10%, and vacancies are rising everywhere. High-rises that filled within days sit half-empty. Landlords dangle every perk. Free months, parking, no deposits. But oversupply isn't the whole story. Affordability hit a wall. Wages stalled. Inflation eroded financial cushions. Student loan payments squeeze younger renters. More people are roommate shopping, moving home, or leaving entirely. Even suburbs like Cobb County and Gwinnett are caught in the downturn. Single-family rentals linger on the market. Short-term rental owners slash prices desperately. For years, Atlanta was praised as the sustainable growth blueprint. Now it showcases what happens when growth loses balance. In 2026, even the Sunbelt's most stable market is caught in the storm. Number 7. Las Vegas, Nevada, when the house doesn't win. Las Vegas operates on extremes, and in 2026, landlords are taking the hit. For years, the city seemed unstoppable. Californians fled in droves, chasing cheaper housing. Investors grabbed properties fast. Short-term rentals multiplied, and the boom felt endless. But this year, momentum vanished. Since 2024, rents have fallen close to 11%, and vacancy rates nearly doubled. Large complexes in Henderson and Summerlin have entire empty sections. The Strip still glows, but beneath that shine, the rental market is severely oversaturated. Tourism, Vegas's lifeblood, hasn't fully recovered. Casinos hire fewer workers. Conventions draw smaller crowds. Service employees earn less in tips. Simultaneously, thousands of Airbnbs are dumped into long-term rentals as owners salvage whatever income they can. Homes that commanded $2,400 monthly now struggle at $1,900 with little interest. Landlords who bought at pandemic peaks are cutting rents just to cover costs. Small investors are quietly exiting, selling at losses to avoid deeper damage. Yet more units keep arriving. Developers completing projects approved during the boom, flooding the drowning market further. Vegas in 2026 carries unsettling déjà vu, echoes of 2008 in modern clothing. The city confronts the consequences of oversized bets on unrealistic expectations. The lights remain bright, but behind the spectacle lies a reminder. When speculation runs wild without solid fundamentals, the house wins. And this time, it's not the landlords. Number 6. Phoenix, Arizona, Desert Mirage. Turns to dust. Phoenix, the Sunbelt's blazing epicenter, is cooling faster than anyone predicted. Not long ago, it was the poster child for explosive growth. Families from everywhere streamed into the valley, sending construction into overdrive and pushing rents skyward. Developers couldn't build fast enough. Entire communities in Chandler, Glendale, and Mesa appeared overnight, built on promises of endless expansion. But by 2026, that optimism evaporated. The city drowns in excess supply. In 1 year, over 30,000 new apartments hit the market, far exceeding available renters. Average rent has tumbled roughly 13%. Property owners frantically compete with every incentive: free months, furnished units, prepaid utilities. Buildings with waiting lists now beg for tenants. The skyline looks vibrant with cranes and towers, but beneath that image, financials are cracking. Insurance and maintenance costs have surged. Investors who paid top dollar during the pandemic are underwater. Phoenix's job market is tightening too. High interest rates, slower migration, and stalled corporate growth mean fewer newcomers and paychecks. From downtown to the East Valley, owners face harsh reality. Runaway growth without sustainable demand collapses under its own weight. Phoenix in 2026 isn't cooling, it's correcting. A metro built expecting 10 million people confronts the fact that demand barely supports 8 million. Unchecked expansion hit its limit, and consequences are coming due. Number 5. Dallas, Texas. The Invincible city falls. Dallas carried an aura of invincibility. Major companies kept relocating, drawing young professionals who filled uptown, high-rises, and fueled suburban sprawl. Investors discuss Dallas as Texas's economic heartbeat, too powerful to slow down. But by 2026, that belief shattered. Rents in Uptown, Plano, and Frisco have declined about 11%, and vacancies in Class A buildings hit levels unseen in over a decade. The skyline glows beautifully, but behind those towers, landlords grow desperate. The explanation is simple. Developers built far more than the market could absorb. From 2022 through 21-25, tens of thousands of apartments came online as renters pulled back. Inflation devoured spending power. Interest rates stayed high. Tenants downsize, split costs, or move home. Landlords deploy incentives they hoped were gone: free utilities, parking, rent credits. Investors watching steady cash flow see margins vanish as insurance climbs and taxes consume earnings. Dallas symbolized unstoppable prosperity. Now it's trapped in a dangerous loop. Too many luxury units, too few affordable options. Even Dallas's corporate sector can't rescue the market. Tech and finance employers freeze hiring. Fewer apartment hunters arrive. Longtime residents get priced out of communities they built. Dallas still looks stunning from afar, but at street level, the narrative shifts fast. The city with unlimited fuel is learning even Texas engines can stall. Number 4. Boise, Idaho, the mountain bubble. Boise was the pandemic-era's unexpected darling, a quiet mountain city that became America's housing sensation. While major metros struggled, Boise became a beacon for people seeking space, beauty, and slower living. Remote workers fled the West Coast with cash, triggering bidding wars and launching prices into the stratosphere. Developers scrambled to keep pace, convinced demand would never fade. But by 2026, that glow has worn off completely. Average rents have fallen approximately 14%, the steepest drop in the Mountain West. Downtown apartments that leased within days now sit empty for months. Boom-era developers who rushed sleek complexes are facing brutal reality. They built for tech incomes, but Boise's core workforce, teachers, nurses, service staff, never had Silicon Valley paychecks. They watched rents break $2,000 during the frenzy, then watched the transplants who drove it pack up and leave. With remote work fading and migration slowing, Boise's supercharged market teeters on weak foundations. Even coveted suburbs like Meridian and Eagle are hit hard. Construction sites sit silent. Investors unload properties at losses to avoid deeper damage. Local businesses that thrived on newcomers are struggling. Coffee shops and restaurants that buzzed with fresh faces are cutting hours or closing. Landlords drop rents by $400, $500 monthly, throw in free months and upgrades. Yet many units stay empty. Boise's story is poetic and painful. The refugee from big city chaos became the prime example of what happens when migration stops and hype evaporates. The escape ended. Reality rushed back. Number 3. Seattle, Washington. When tech's foundation cracks, for the first time in over a decade, Seattle's iconic skyline feels uncertain. After 10 years of relentless expansion, soaring rents, and crowding cranes, 2126 delivered a sobering correction. Average rents have fallen roughly 11%, and gleaming towers symbolizing limitless opportunity now show vacant floors and struggling owners. Much of this stems from tech's unraveling. Layoffs at Amazon and Microsoft, plus startup failures, gutted the renter base that sustained the boom. Downtown buildings with waiting lists now offer cash incentives and free months to attract tenants. In Capitol Hill, South Lake Union, and Belltown, where discounts were unheard of, luxury apartments openly advertise price cuts. The ripple extends to suburbs. Bellevue, Redmond, and Kirkland show identical patterns. Renewal rates drop. Residents move out. Developers watching inventory accumulate have paused or abandoned major projects, leaving skeletal structures as monuments to the belief that demand would always outpace supply. But the deepest transformation is mindset. The pandemic permanently altered how people think about work and lifestyle. Many who prioritized Seattle's prestige now choose smaller cities or different states where income stretches further. The migration isn't massive, but steady. Each departure takes another slice of stability. For landlords, this shift humbles. Renters negotiate again, demanding flexible terms, lower payments, and concessions that were laughable years ago. Those shimmering towers reflect a harder truth. The market isn't invincible. Seattle in 2026 still looks breathtaking in the mist, but underneath lies fragility, a reminder that even tech-powered economies have limits. The tremors shaking this city come from an industry learning that perpetual expansion is impossible. Number 2. San Francisco, California. The innovation capital collapses. If any city embodies collapse right now, it's San Francisco. Once the undisputed epicenter of American innovation, the rental market has deteriorated into something unrecognizable. Average rents have plunged about 16% in 1 year, and downtown vacancy rates have shattered every record. High-end towers that commanded $4,000 monthly now struggle to fill units at $3,000, with incentives stacked on top. The tech worker exodus that began during lockdowns never reversed. Remote work solidified as standard. Downtown, once humming with startups and venture capital, transformed into a corridor of quiet glass. Entire blocks resemble ghost towns with permanent for lease signs. Landlords who bragged about passive income now beg for occupants. Operating costs, taxes, insurance, maintenance surged to where profits evaporated. Investors who bought at peak prices are trapped, unable to refinance without massive losses. Beyond numbers lies something more destructive: perception. Concerns about safety, homelessness, and quality of life push renters away faster than discounts can pull them back. Professionals who might have chosen San Francisco opt for Sacramento, Austin, or Denver, places offering more space, less stress, and stability. The cultural fabric bears weight too. Restaurants, shops, and galleries that gave San Francisco its character are closing permanently. Each closure strips away what made the city irreplaceable. Even the tech identity is fading. Major corporations quietly abandon headquarters for cheaper, cleaner hubs elsewhere. The irony is painful. The city that set the national benchmark for sky-high housing costs now demonstrates how dramatically low markets can sink when everything sustaining them pulls away. San Francisco's downturn isn't temporary. It's a fundamental transformation etched into empty storefronts, a warning about what happens when innovation races ahead without grounding itself in sustainability. Number 1. New York City. The unthinkable has happened. At the top sits the giant nobody expected to stumble, New York City. For generations, its rental market felt untouchable, no matter what crisis hit. Recessions, pandemics, crashes, demand always snapped back. But in 2026, that assumption is finally losing power. Average Manhattan rents have dropped about 13%, with Brooklyn and Queens seeing declines approaching 16%. For the first time in memory, renters, not landlords, hold genuine leverage. Incentives that disappeared years ago returned dramatically. Free months, waived deposits, upgraded appliances. Developers who poured concrete between 2022 and 2024 believed wealth would flood in indefinitely. Instead, their towers overlook half-empty streets. Layoffs across finance, tech, and media gutted the high-earning renter base. International buyers who acted as Manhattan's economic engine are retreating, spooked by instability, tax hikes, and rising costs. Even the ultra-wealthy are pulling back. High-end properties along Billionaires' Row are discounted by staggering amounts, unthinkable 24 months ago. Mid-tier building owners face refinancing terms so harsh they're choking cash flow. Smaller landlords whisper the word New Yorkers avoided for years: foreclosure. Meanwhile, young professionals once willing to sacrifice everything for a cramped studio are looking elsewhere. Charlotte, Nashville, and Philadelphia suddenly appeal more, offering substantially more space and less financial pressure. New York hasn't lost its energy or character. The speed, diversity, and chaos remain. But fewer can afford staying. New York's downturn isn't explosive. It's gradual and unmistakable. The city experiences a slow tightening, recognizing that even here, growth has boundaries. For the first time in living memory, New Yorkers say the quiet part aloud. The empire of rent hit its ceiling. The skyline still shimmers magnificently every night. But beneath that glow exists a city pausing, perhaps for the first time, to simply breathe. The bigger picture. America's housing revolution. Across the country, something significant unfolds. A quiet revolution reshaping America's housing landscape. For the first time in over a decade, renters possess the upper hand. The era of bidding wars, panic applications, and relentless rent increases gives way to empty apartments, sliding prices, and scrambling owners. But this extends beyond numbers. It represents a fundamental mindset shift. Millions question whether renting or buying makes sense when living costs climb while wages stagnate. Developers chased luxury. Renters wanted affordable homes. Investors hunted returns. Families needed stability. The imbalance caught up with everyone. Some cities will bounce back. Others may shrink permanently. But the lesson is universal. No housing market can outrun economic reality forever. The numbers tell a story. The question is whether we're ready to listen. What we're witnessing isn't the end. It's the beginning of a transformation in how America houses itself. The cities are changing. Power is shifting. And for the first time in years, that might actually be good.